Ben, we want to be respectful of your time. Thank you for taking time out of your day to kind of join us here. For those that have kind of been down this road with us before, you know that we certainly want to help filter, I think is the right word, a lot of the information that's out there, just in our way to kind of keep you focused on really what we know matters most to you. And that sometimes means it's a struggle to kind of balance too much information with not enough. So we don't want this to replace individual conversations, but we also want to be clear, we're not alarmed. We don't want you to be either, but worse than no information is misinformation. So today we really just want to open up and, acknowledge we're here, we're on top of it, everything's going to be okay. And if you have questions, we certainly want to go through them. So as Adam said, we kind of have a framework that we're kind of planning to follow, just a brief introduction to what we've come to learn about how emotional investing can be. I want to do just a very brief explanation on terminology that's thrown out there. I think it's important that we kind of all speak that same language and understand what is a bear market, what is a recession. I think that helps answer ultimately the two questions that you all, need to have answered for yourself. What does that mean for me, and should I be doing anything different? So we'll go through that brief introduction, and then we put together, based on a lot of our recent conversations, just the four most popular questions we're getting. But as Adam noted, that doesn't mean we want this to feel like a presentation. If you've got a question along the way, let's go through it. If you've got something at the end you want to go through, we'll make time for that too. So there's the outline. I'll start, with some of the realities of investing. We know it's emotional. It's a pure and simple fact that, we're all going to go through that. I don't think we've ever met anyone that's 100% immune to the feelings of fear and anxiety around investing. If money is the tool that, we all need to kind of live the life that we want to live, it's natural then to get emotional when we see things, going up and going down. There's a reason people liken it to a roller coaster. I'm going to skip to the next slide. I like this because I think it really does speak to where all of us kind of get to at different phases in investing, that point where things feel really great and we're optimistic and we hit euphoria, to when we start to see things going down. It's human nature to have anxiety and fear around that, to almost to the point where we're panicked before hopefully things turn back around and we feel good again. So I say that because I want you to know that whatever you're feeling right now, it's normal. And this is a moment in time. We're going to come back up that roller coaster again. But even if you've experienced this before and you know that, and your mind's kind of wired to know that you just sometimes have to have some patience, it's true that human beings are 2.5 times more concerned about avoiding losses than they are about potential gains. And we're going to go through some of this today. I think that's why human nature, sabotage is a really strong word, but it's why we can sometimes get in our own way. We feel we need to adjust something, change something, when maybe that's not the best thing to do. And frankly, it's also the reason why the media is very successful in sensationalizing news for us, because that is what draws attention, the fear side of things. So the theme today is, certainly we don't want you to be fearful in these moments, as bad as they feel, and hopefully by going through some historical context, remind you that this is somewhat normal. And these bear markets have always been followed by new highs. So Adam, I don't want to keep rolling here. Anything you want to add to that?
Yeah, it's funny. We've prepped for this. Clearly, we've had these similar conversations in past podcasts, but this literally just popped into my head. I almost, in thinking about that 2.5 times more important or more psychologically effective of avoiding losses versus achieving those gains, I almost liken that to you're driving on the highway and there's a traffic jam. And how often, I know I'm this way at times, where I'll take a detour as long as I'm still moving. But in the end, it may have been quicker to sit in that traffic, right, to get to your end result, rather than taking, the scenic route and maybe taking a little bit longer. But it's the feeling of I need to take some action. Some action is better than just sitting here doing nothing. And sometimes I'm using that as the example that maybe it would have been better off time-wise to just sit, let things play out, just relax, and not necessarily divert off course. But that literally just popped into my head. Yeah,
and that's fair. And I think that's why you put this cycle here, because we don't we run the risk anytime we go through a presentation like this of saying, hey, be patient, this is normal, of trying to minimize those emotions. And that's not really the point we're trying to make. It's to acknowledge whatever emotion you're having is normal, it's okay. We just always want to come back around to, do we need to act on those emotions or not? And sometimes we want to tweak things, and we need to be responsible for that financially too. But it certainly is to make sure that whatever you're hearing out there, GPS tells you to take this detour, using your example, Adam. Is that really what's best for you or not? And some of that's going to be personalized, but I think for today, we really just want to provide enough context to make you feel that if you are on this lower end of this cycle here, that you're comfortable knowing that you're not going to stay there, right? These feelings will change over time as we get ourselves back into a better spot. So last bit of context before we go through some graphs that Adam and I really like. A bear market. We've officially hit a bear market, and what that means is that the broader stock market, we're going to identify the S&P 500 today as really our point of context. It's dropped more than 20% from its all-time high on January 3rd. So we'll go through what that means. When you hear the word correction, same concept, coming down off of a 52-week high, but that's defined by 10% off that high. To give you context on those two things, we've had 11 bear markets in the last 70 years, and we'll show that. We're going to show a list of 16 that were bear market or very close. We've had 11 10% corrections just in the last 12 years, right? So the frequency of these are important context too. The other main one right now is that R word, that recession word. And we just want to be clear, that's not really an investment term, it's an economic term. And that's defined by that general decline in economic activity, which we place GDP as the indicator of that general decline happening in 2 consecutive quarters. So first quarter showed our first. Will we see another decline in the second quarter? We don't think so. But just want to be clear, recession does not mean bear market, and bear market does not mean recession. We can have historically, we have had bear markets around recessions, but not every bear market is a recession.
Right.
All right, this is probably going to be my favorite graph, because I think sometimes the context of how have we got here is really important. And when we are able to actually zoom out, we really do see how far we've come. I like to liken this to a really painful long run for me. You kind of get sometimes to the end of it and it feels horrible because it was really hard and painful. And then when you turn around and see how far you've come, your perspective just changes a little bit. Doesn't make that pain go away, but there is a sense of sometimes progress or of accomplishment. There's some positivity to that. And this graph really does that for me personally, and then I hope for you too. This graph on the left goes all the way back to 2008, the market crash that was 2008, up until essentially, the 21st was Tuesday. That blue line is the S&P 500. So we certainly see some dips in here, but when you're able to zoom out, you see that really nice, strong trend upward. And what I really like about this graph too is that yellow background that you see, the pale yellow background, really is shaded to then represent positive times. When the kind of pale blue, or I don't know, is that lavender?
I'd call it lavender, sure.
I only think in like 8 colors. And the pale pink, that's going to be represented by those times of decline, right? Pink being those 20% downturns that we're referencing as a bear market. This pale color not quite being 20%. So I think this one I like a lot because it is to scale. It is indicative of time, but it also kind of shows me that those positive times certainly vastly outweigh the negative. So it doesn't feel like that right now, right? We're in this pink time, but really we've come a very long way since the bottom of, pick your time, little dip, of course, that we had in COVID time, the end of 2018. Really, we hadn't seen anything like that since the very end of 2015. So we've been fortunate. Anything you want to add, Adam?
No, not yet.
I do like that prior graph a lot because it doesn't isolate returns or declines to, I think, what we're all kind of prone to, and that's arbitrary time periods. The media does this very well. What's happening this week, this month, this year, since the last election. We'll get the headlines that we're down 20% this year rather than what we just saw. Hey, we're up 100% since the bull market started. So point being, it's all perspective on how we view it. What I do like about this JP Morgan graph is how it shows intra-year declines can happen even in those upward trends. Right? So to explain the graph, these gray bars are your annual returns going all the way back to 1980. So we've seen positive annual returns in the S&P 500 75% of the time, right? It reads here in 32 of the last 42 years. But even while that's happening, these red dots are representative of intra-year declines, the low point of the market in the middle of that year, whenever it occurred. So you can see that even in positive years, we've sometimes felt those dips. And maybe we have some recency bias around that, or again, it always feels worse when you're in it.
Yep.
But I think what's really telling on this graph is to see, even in those positive years, 2020 being the most representative, the most recent year, we were down 34% at the onset of COVID-19 and ended the year up 16%. That's a 50% swing in 1 year. It was rather similar in 2009, coming off the huge decline of 2008. So ebbs and flows, of course, but it does show that the average intra-year decline in the market is 14%, and that's a correction, as we kind of defined it earlier.
Yeah, I really like this slide, Ben, because it does, and I'm glad you used the term recency bias, because it's often, what has the market done for me lately? And that's the most recent thing that we all kind of anchor to, just how bad have things gotten, and then on the rebound you kind of compare to the bottom, and then vice versa. We had the all-time market high on January 3rd, and it's kind of felt like it's been this downward trend since then, and it has been. But this volatility kind of shown here, and I know there's some more slides to come that kind of show a little bit more context on just the return side of things. Volatility is the price for long-term growth when you're investing in stocks. So this, to me, is that picture perfect example of, in any given year, you are usually not spared from some sort of loss throughout the course of that calendar year.
Yeah, that's a good way of putting it. And these hopefully are in a good order for us, because this kind of speaks to how far that pain can be felt, right? Those red dots, and the lower they go, the more painful it may be. But pain can also just be for longer periods of time too, right? It's the difference between ripping a Band-Aid off and that quick pain, and what this year has kind of felt like a slow meld down. So these next couple graphs kind of put length of time to be the focus, not necessarily the percentage of gain or loss. And what this is showing is the bull markets, right? Those good times since the end of World War II have usually been pretty prolonged. On average, what this is showing is the S&P's gone up during that bull market period, no matter how many months it was. On average, it's more than doubled, right? 156%. And it's usually a 5 to 6 year period of time. If you take out COVID-19 kind of very quickly putting us into a bear market and a recession, following the 2008 market crash, we were in an extremely long, right? It was more than 11, but that's close to 12 years.
Yeah.
Well, a little more than 11 of a bull market, where we see over a 400% rate of return in the S&P 500. Since the bottom of COVID-19, this was the fastest bull market to kind of double in price, but it was also really the shortest, as you're looking at this, since the late 1940s. So we were quick to come out of it. We were quick to double, and it was very short-lived. But again, I think when you put an extenuating circumstance of completely shutting down the economy for a period of time, you almost have to look at, and that's why I put in the title of the slide, the last two bull markets almost as one.
Yeah.
Can't go through the positive side without talking about the negative side, right? And that's how long are we really going to be in this period? Or this graph is really showing from the peak to getting into that bear market. And that's what we kind of want to recognize over these last couple months. we've been feeling the downturn. So even though we didn't hit the bear market until just this month in June, for many of you, for many investors, you may have been kind of like feeling it coming, because it has been this move down pretty much throughout the whole year. But what I really like about this graph showing now this is showing 16 different bear market periods. Again, technically we've only had 11, and you can see these, we didn't quite get to 20% in a couple of these, but it's good context. Over the last 70 years, these 16 times, this 5-month period that we've been in, if you look at the bottom half of this graph, this really is already feeling long. And I go back to my comment on, it's not necessarily the 20% pain that we may be feeling now, it's that this is feeling longer than some of our more recent periods. Go back to COVID-19. We went into that bear market quickly, but we came out of it quickly. So it wasn't that prolonged pain. It was the same thing at the end of 2018, only 3 months, 5 months going back to 2011. We had the financial crisis that was 2008, the tech burst of early 2000s, but even the 3 before that, on average, these have kind of shown more of like 3 to 4 month periods. And now by our standards, this one's already feeling like a kind of a little long compared to those other more recent ones. Anything you want to add, Adam?
Yeah, I think that it speaks to how, in this instance, the stock market is so very forward looking, and that when potential surprises do arise, the market prices that in and corrects very quickly. And then on the flip side, once there maybe is more clarity or there is some positive news, the market then again kind of takes that and runs with it. And that's where I use the analogy all the time of the pendulum swinging too far in either direction. And that is certainly the recent history that we've seen, that these bear markets have been very quick and the rebounds have been equally as quick. So the fact that this may not necessarily feel that way right now, time will tell how long it lasts and how quick the rebound is, but it does just speak to the recent experience. This feels a little bit different in that sense, just from the time frame.
That's fair. So if that's the historical context, here we are 20 minutes in, nobody's saying it to me out loud, but maybe you're thinking of it, okay, that's fine, but where do we go from here? Who knows? But again, historically speaking, what happens next after a bear market is typically some pretty positive returns in the S&P 500 3 months later, 6 months later, and 12 months later. There are these circumstances, of course, where we hit deep recessions, where 12 months after you hit the bear market, you're still feeling the pain of negative markets. But 70% of the time, 12 months later, we've seen not only positive returns, but nice positive returns, on average close to 15%. So the good news here is, we'll talk about recessions next, if we're not going to be in some sort of deep economic recession, the good news is the market typically goes higher shortly after that bear market. To get back to that R word, if you don't have the recession, again, how long does it take to really then get out of it? 7 months on average is what this graph is showing over the last 1, 2, 3, 4, 5, 6, 7, 8 bear markets that didn't have a recession. In the 3 that we did, there's certainly been some bigger pain. The market really got close to being down on average closer to 30%, which looks more like that flash crash in 1987. So again, what does that all mean? Time will tell on recession, and we're going to get into interest rates and the Fed and really what we think is happening right now. I promise this is the last one that kind of gives big historical context. But really, what's the takeaway? I'm not sure if the stock market has bottomed. I'm not sure if we're there yet, but these historical pieces of information do suggest that if we do not think there's going to be a recession, and I don't in the near future, then it may be more, hopefully the worst is over, or there may be more limited pain from where we are today.
Right.
Okay, so question one, bear markets, what do they mean? Where are we at? I want to move to maybe the more important question, I would say, to our client base, and I think that speaks to anyone that's on the call. We're diversification people, right? As much as we were kind of just illustrating the bear market for the S&P 500 or the Dow Jones or whatever index you look at, the idea of financial planning and building portfolios for long periods of time is that we want to diversify our holdings. So we need to talk a little bit about bonds as the other half to investing in stocks. And this graph is busy. And there's a lot of information on here. So let me do my best to just share that when we say the S&P 500 is in a bear market, that's really just this green block. And I'm not sure if my cursor shows on this graph, right? That's large US stock. Each one of the other colors is a different asset class. Going left to right, this graph goes all the way back to 2007. And year to date, as of May 31st, 2022, that's the last time JP Morgan put this out. Drawing your attention to this white block that's connected by the black line and dots is really supposed to be indicative of asset allocation. Point being, if we spread out our investments in all these different asset classes, we don't really have the whipsaws of, am I going from first to worst, back to first, and jumping around like some asset classes do. Now, what I want to draw your attention to is all the way on the right here, annualized rate of return over the last 15 years. If you've invested in the S&P 500, you've done, and solely in the S&P 500, you've done very well. That's been the best performing asset class. If you've invested 100% in fixed income, this is showing the annualized rate of return of around 4%. Are we feeling that this year? We are not. What's up with bonds? We're going to get into some more details, but fixed income is down close to, I guess it depends on the sector, 8%, 9, 10, 11, 12. We have not seen bonds do historically what they've done over the last 15 years and even going back further, where you had very low volatility. That's the last column here. Fixed income is second only to holding cash, but we've seen negative returns, even though it's high on the year returns. You've really been spared in no way other than holding commodities this year. So diversification feels like it's not working, even though if we put it in the context of the last 15 years and even going back further, it certainly has. I'll move to the next if you've got nothing, Adam.
Yeah, you're knocking it out of the park.
Oh, you're too kind. So I don't have a lot to say here other than to draw your attention one step further with bonds. This quilt is structured the same. It breaks down bonds into its many different subcategories. So the key here is that bonds can mean a lot of different things too. There's different types of bonds. There's different time periods to bonds. There's different risk associated with different types of bonds. So this is the same idea going back to 2007. If you diversify your bonds, you stay somewhere in the middle here. That's pretty consistent. You've aggregated an average return of close to 5.5% with not taking a heck of a lot of volatility. But again, nothing's been spared this year. You probably can't read it, but the best performing bond is still negative. I think that's negative 2.4.
Yeah.
Emerging market debt, negative 15, right? So somewhere in the middle here, when it talks about the bond market, the Barclays aggregate is often what's quoted. As of the end of May, we were still down close to 9-10%.
Yeah, I think people often understand that investing in stocks and equities, that comes with volatility, that comes with some level of risk. Not so much on the bond side or the fixed income side. That is meant to be your more stable investment, right? When stocks are going through rocky times, you want your bonds to at least hold their value. They don't necessarily have to appreciate, but oftentimes they do have that inverse relationship. But this year, there's been a multitude of variables here at play, and I like this graph, Ben, because it does show that just like stocks, not any one stock or sector or globally, nothing is they're not all the same. They do act differently in different market environments, even within bonds. I think people just think either it's a bond from a company or it's a bond from the government, and that is true. But there's so many different slices of that market that you really can get access to, and the returns do vary fairly significantly at any given point in time.
Yeah, you see a negative number in 2013. I remember that year well. And then you see a negative number last year, just barely. This year is where the pain has been felt. And I guess the follow-up question is why? What is up with bonds? It is interest rates and inflation. So this graph does a good job showing yield, as illustrated by a 10-year Treasury note. And some of you may remember this well too. You took out a mortgage in the late 70s, early 80s. You might have been paying double digits on that mortgage, where rates, yields have dropped pretty much on a look. There are movements here, right? There are little peaks, but if you look at the trend line, we had 40 years of declining yields. And you use the word inverse relationship, Adam. That's kind of the point here. As yields have dropped, prices have gone up, right? Think about it. If you owned a 4% bond and now the best bond you can get is 3%, wow, your 4% bond has a better, it's more attractive. And now we're kind of going the other way around. You've got a 2% bond and somebody can go get a 3% bond. Nobody wants your 2% bond anymore. So while the trend was down for 40 straight years, now what has caused rates to go up? It's inflation. The Federal Reserve has been very clear with us. They're hot to trot to raise rates because they believe that that's going to help combat inflation, the inflation that we're feeling everywhere we go, grocery, energy prices, everything. So I think this graph does a good job kind of showing historically, how have we gotten here? What's up with bonds? I don't know exactly where we go from here, but a lot of people would say that pain in bonds has probably already been felt. And hopefully what's going to come after that is the good feeling of why you own bonds, to get yield, right? For it to pay you something. And while yields were very low, for an extended period of time here, the last couple of years, okay, now our bond prices have deflated, but if it's going to give us better yield moving forward, hopefully those things will balance out.
Yeah. So on that note, Ben, I think that is, who knows where interest rates go from here? Who knows what happens exactly with inflation over the course of the next year or two? But it is, we do believe that the majority of the pain has been felt on the bond side. So now that rates have risen, and it's not necessarily so much how much that the rates have increased. So using the 10-year Treasury as kind of the benchmark, we started the year close to 1.5%, and now we're well over 3%. Well, I think we're now hovering around 3%, but it got as high as like 3.4%. It's the time period over which that move has happened that really causes the volatility in the market, the bond market here specifically. The good news, if there can be good news in all of this, is that historically, current yields or the current bond rates are usually a pretty good predictor of future returns. Majority of bond value or kind of real return to you as the investor comes from the dividends that are generated. So there are oftentimes, if in this chart here, if we see that graph kind of sloping down to the right as yields are falling over time, there is the ability for capital appreciation. But more often than not, you're buying those bonds for some stability and for the income that they generate. So if there is a silver lining here moving forward, we do believe that bond returns will feel more historically normal now that we're starting from a higher point than where we were certainly to start the year.
Yeah, I'll go back to my Band-Aid analogy. It's almost like the bond market went through that ripping of the Band-Aid.
Yeah, yes.
And it really hurt and it really smarts. And again, if the question is, well, shouldn't I do something differently? Well, maybe not. If it happened that quickly, in some ways unpredictably, at least how quickly it happened, then we still need to go back and assess what is best moving forward. And again, we're going to be optimistic on that because we think there's good reason to believe these yields will be good for portfolios and price stability will be there. And so maybe that's a good segue into this next one. When I noted at the beginning that this is merely a point in time, everything that we've just shared with you stinks. Stocks stink. Bonds have not felt great. If you look at this graph, this is busy too, so I'm going to do my best to explain it. If you were invested just in stocks, and this is going all the way back to 1950, you could have had a 1-year really poor rate of return of close to -40, but you could have had it as high as 47%. If you were just in bonds, any one year, your worst experience could have been -8 or could have been as high as 43. If you jump to this next grouping here, that's just a 5-year rolling period then. Things look much better real fast, right? That spread between returns is much more muted, right? Said differently, if you were just in stocks and you did nothing for a 5-year period, worst case scenario, you were down -3. As good as it could have gotten was 28%, right? So keep going out all the way to 20 years. If you were in a blended portfolio, right, a diversified portfolio over any 20-year period of time from 1950 up until the end of last year, you should have expected somewhere between 5% and 14% annually, right? Which is why we draft financial plans to say, over long periods of time, what can we expect you to make? Historically, this is showing that. So maybe I should put that a different way. I think the key takeaway is, if you stay in the game, if you're able to kind of work your way through the emotions of any one given year, when you take shorter chunks of time, 5 years, maybe investments for as long as 20 years, if you stay in the game, you're not going to lose money, is what this is showing. And I'm not saying that it doesn't hurt to be in this camp. It certainly does. But this is truly, I'm not immune to emotions either. This is the graph that kind of helps me keep things in context over longer periods of time. All right, I think we have 2 more. So we're getting there, and then we'll open it up. I think what I just shared on the last graph, this one ties into it very well. And it's equally busy. So I'm actually going to focus on just the bottom half. And this actually, to me, illustrates why we need to stay in the game and not get too cute about overreacting. I just shared on the prior slide, if you take those rolling 20-year periods, a balanced portfolio, you're somewhere between annualized 5, 6, 7%. This bottom part of the graph here is showing just the last 20 years. And it's still true. These 2 blue bars are showing that whether you had 60% in stocks or 40% in stocks, that 6 to 7 range is what you would have experienced. If you were just in the S&P 500, you would have been on a heck of a roller coaster ride, but you still would have annualized close to 10%. This orange block right here shows the average investor rate of return of 3.6. Now, how can that be? There really has to only be one explanation for that, and that just has to be investor behavior. That has to bring the emotional side of making changes, succumbing to the urge to jump in, jump out, time the market. Investor behavior has to be then what has caused them to experience less growth along the way. And I think this is what it kind of speaks to that old adage that you kind of have to set it and forget it. This data is suggesting that. We don't intend to sabotage ourselves, but in a way that ends up happening sometimes when we try to time the market, or we react to a certain market environment and end up selling at the wrong time and buying at the wrong time, and vice versa.
Yeah, and so just to reiterate kind of what I said earlier, Ben, that very much feels like taking action for the sake of taking action, right? I'm going to take this detour because I feel like I'm still moving forward. I'm doing something. I have control over something, and it's that feeling of control that I think oftentimes it kind of scratches that emotional itch or that psychological itch of, oh, I'm doing something. That feels better than just kind of sitting and being an inactive participant in the stock market. But that's certainly where we've seen. I'm thinking back to, I'd have to pull the exact specifics, but there was a study done by Fidelity Investments. This is years ago now, and it's kind of morbid to think about. But what they found in all of their accounts within Fidelity, the best performing accounts were typically those that people forgot that they had invested with Fidelity, or the account owner passed away and Fidelity was never notified, meaning those accounts were never transacted. There were no changes being made. They were literally just those set it and forget it static portfolios that over time, Fidelity found within their own studies, those outperformed many of their other clients' investments, which that just blows me away.
Yeah, it's crazy to think about. And again, now I'm kind of, in listening to hear you say that, I don't want to make these graphs and everything that we're sharing illustrate that inaction should always be what we
Correct.
do.
Right.
On the flip side of an action is to take action when you feel like there is a disconnect that you can benefit from. Right. We made certain changes in our bond portfolios back in May. There have been times where rebalancing your portfolio makes a lot of financial sense, so that you're not leaving so many gains on the table, or you're able to buy back into things that you think will continue to go up over time. So not to do nothing, but sometimes we liken that to, your words, not mine. It's a light dimmer. It's not flipping the switch on and on. And I think that's what I want to share here. Sometimes we get the question, should I just go to cash? Well, that's really never going to be how we want to look at things, because we don't want to miss the opportunities to stay invested, because over time it does work. All right. Maybe you can help me with this one. I know that we get questions in times of stress that sometimes are around ideas on certain ways to handle it in a current environment. Should I buy gold is one I feel that comes up every bear market. And this is a tough graph to explain too, because I think it gets very technical, but I'm going to do my best, and then you can correct me by putting it into easier terms. What this is showing are different asset classes. Again, if the purpose of diversification is to hold different things that act differently, this is the graph that shows how they act differently. We use the word correlation, but it really is to say these two asset classes in the same exact environment, how alike are they? So as an example, if we take that S&P 500 US large cap stocks and the EFA, which is representative of, we'll just say, international investments, 87% of the time, right, 0.87, they act the same, right? So one is they act completely the same. -1, they have a complete inverse relationship. The question on gold in the last column here is, it only acts like stocks 3% of the time. Bonds 2% of the time, by the way. So if the question is, should I buy gold because it doesn't act like stocks? Sure, that could be the case. And that may be a further diversifier for you. Why I like this graph is the last column here shows annual volatility, right? So volatility would be variability in their returns over time. We expect, I think you said this earlier, we expect stocks to be volatile, represented by a 14% variability in any given year, right? International at 15. We expect bonds not to be variable. That's 4%. Look down here at gold. Clocks in at 15%, right? Price variability higher than stocks, historically speaking. So again, going back to the question, this graph kind of says, well, why do certain people say I should own gold? Because it's diversifier, great. If it's to try to limit your volatility, it may not serve that purpose. And if we're talking to people that historically have a more conservative profile, we have to be careful about that. Nothing?
I got nothing else to add to that.
Let me jump back, because sometimes it's represented by commodities here too. That's the dark green here that kind of sadly hangs out at the bottom. We've seen commodity prices do very well this year, right? It's really the only asset class on this graph that has been spared by negativity. But even with that return over the last 15 years, commodities are still showing an annualized negative rate of return, right? So that's probably the best example of, well, let me use my recency bias and say this is performing well, so let me jump in. You may be well served by that in the short term, but who knows where things go from here. Commodity prices have been a diversifier, but they haven't really benefited portfolios, at least in this more recent history. All right, I'm going to be quick with this last one. Because I think the last question we sometimes get is just around cash. Should I hold more of it or should I invest it? I want to be clear. We as financial planners look at cash as really important to the financial planning process, especially in retirement, because if you have the cash you need to meet several months or maybe even a year or two of what you're spending, the point is to give yourself permission to be a longer term investor then. right? We don't want any of these short-term market moves to impact your ability to pay bills or live the life you want to live. So having cash, permission to then, if I go back to diversification over periods of time, means we don't have to worry about this 1 year rolling return. We can focus more on the 5 year rates of return, right? We don't have to be emotional about it. And I think what I want to illustrate here with this graph is sometimes people think then not about cash as what I need to spend and permission to be a long-term investor, but they think of it as an investment, or in today's term, if I hold more of it, then I'm safe from market conditions. This shows the pain actually that can be indirectly felt by holding too much cash. Yes, going back to 1994, the gray here is showing the interest that you would have collected on $100,000, right? So between 1994 and I'll say 2008, you were getting $3,000, $4,000 a year, 3 or 4% in interest by just holding a savings account. But everybody knows that over the last 15 years, then, man, you've collected pennies from an interest from the bank, while this blue line, inflation, has still been floating around 2%, except for now the last year and a half, going on 2 years, where now we see inflation of close to 6%. So this is showing we need $6,000 on a $100,000 investment just to keep up with inflation, but your bank account's paying you 80 right now. So it all comes back to perspective. Cash is an investment. Right now, this tells me you're safely getting a 6% loss on that money because the purchasing power of your dollar is going down. Again, that's okay if that cash is there to be spent. We're not looking to look at cash as an investment. But if I'm using this to illustrate, should I hold more cash? The right answer for anybody is going to be very personal, but if it's giving you peace of mind, sure. Are you safely losing money? Technically, yes. All right, I feel like I've done way too much talking at this point, but I've gotten through my graphs. Are there other questions or anything you want to highlight, Adam, that I didn't get to?
No, I don't think so. I think we can open it up to questions, if anybody has any.
So I have, well, you know, as a recent investor who started out late in life and really wanted to make a killing, sort of, it's a little depressing to like be losing money. So, I mean, I just want to like, you know, say that in the beginning. But my question is, in all the current events that are going on in the world today, where, I mean, it's like a big upheaval with a lot of things going on that's very unstable all over the place. Has it changed your thoughts on how you would want to invest or not invest, or what you would, you know what I mean, like want to invest in? Like, what do you see in the future? Not that you're not saying in the future in general, but what do you see as a possible growth thing in the future? Because I personally don't see anything, but
yeah, it's a fair question. So I feel like I've had this conversation recently with different people, but you know, Ben and I do regularly have these discussions on investments, on our allocations, and it often just feels anticlimactic to get to the end of that process. You know, all of this effort, all of this research, all of the conversation to say, no, we like how we're positioned. We wouldn't necessarily do anything different right now. And this very much feels similar, but kind of to piggyback on what Ben had said earlier, when we make changes from an investment standpoint, that is often, you know, a dimmer switch, not so much we're gonna, you know, flip the lights on and off. You know, so when we're trying to be forward looking now for ourselves and for the investments that we run, you know, we may underweight or overweight certain sectors of the market, whether that's on the stock side, maybe it is on the bond side. But yeah, for as of right now, there are, you tell me if you feel otherwise, Ben, but I think we like how we are allocated. The results just haven't backed that up at this point.
Yeah, I'll try to answer it a little bit more Well, I'll answer it more directly. I can only speak from my experience and the people that we work with. What often drives our emotions is not actually what's happening with corporate profits, I'll say. It's how we feel ideologically, how we feel about the state of the world, how we feel about the things that we will read about in headlines, right? Because that's what drives the emotions. The stock market is really just so very detached at times from what we see and feel in our personal lives. Corporations are still very profitable right now. I know it's crazy to kind of say that when we feel there's war going on and unrest and everybody's kind of upset one way or the other about politics. Like nobody's ever happy about politics. But I think the reason why we feel still bullish, still optimistic about the market is that corporate profits are still good. We're not going into an environment here where we have to question, this is my opinion, we have to question, are all these companies going to go out of business?
Right.
There are times historically when that's been the question, and now you get real fearful about what companies you buy. I think COVID-19 really showed us that while it stinks that corporations kind of put themselves maybe over the common person, again, my feelings, they find ways to adapt and continue to see valuations go higher. And we're now at a point where the stock market has decreased in price enough that a lot of these stocks are very attractive again. So I think it's just a matter of time for, in my opinion, the Fed to kind of get us into a better spot where we know kind of what to expect on inflation, the supply chains maybe to loosen up. And we're going to feel very good about stocks again, value and growth.
Yeah, I think that's also part of the reason why the Federal Reserve has been so steadfast in their, in their messaging that they don't believe that raising rates as aggressively as they are right now is going to lead us into a recession anytime soon, because of all of these other factors at play. As Ben said, on the company specific side of things, companies are still profitable, even with all of these headwinds of, the labor market being extremely tight, the supply chain issues, just the rising input costs of everything across the board, energy being a huge one. And we'll see if the Federal Reserve ends up being correct or not, but that's where they are very confident right now that by raising rates, there is still some buffer built into economic productivity right now that they believe they can achieve this soft landing, using air quotes, where they're not going to necessarily drive us into a recession immediately. There is that possibility that if they get too aggressive, that's going to limit, growth. But as of right now, their feeling is they're going to be able to pull this off. I don't necessarily feel strongly one way or the other, but to Ben's point, I think that's where the backdrop economically right now is not horrendous.
Yeah, and I'm going to answer it one more way, Anthony, because I think this graph shows me that your comment and your feeling on, gosh, I just don't know how this is going to look better anytime soon, is illustrated right here. Like consumer confidence and the stock market, this is defined as consumer sentiment. It's about as low as it's been in an incredibly long time. And that's usually a contrarian signal. And I think that's what this graph is supposed to show. It's that old Warren Buffett advice to be greedy when others are fearful and fearful when others are greedy. Again, hope is not a strategy. I don't want to make it sound like, hey, just, hold your nose, close your eyes, and don't worry about it. But usually when sentiment is this low, it's usually a good sign for the stock market in the next 12 months.
I hope so. I mean, with prices, everything going up, people have less money to spend.
Yeah.
To buy things to stimulate the economy. So, that kind of creates, I'm in the garment center and, it's like, people aren't buying much clothing because they can't afford it. The prices have gone through the roof with the whole supply chain thing and this whole increased freight cost that's driving prices up like crazy.
Yep.
So, I don't know, I don't want to be grim, but it's hard to be, not so grim seeing all this stuff that I live through every day.
Yeah. the only peace of mind I want to give you on that, Anthony, is we haven't quite seen that yet. The consumer still has a lot of cash. And look, again, I don't want to sound insensitive. People of lower income right now are really struggling, right? Because that inflation is hitting them in a hard way. What we're seeing broadly in the economy, though, is the consumer's changing what they buy, but they're still spending, right? Maybe they're not buying clothing, but they're still spending in other ways. So it's not like they're holding on to that cash, which, that tightening sometimes is what essentially becomes the recession. So we could get there, and we could get there fast if, right, prolonged inflation is there for, if inflation is prolonged for a longer period of time. But I think that's why the Fed is coming out and saying, this is now our focus. We want to get that under control. Right. Can they thread that needle? I don't know. But at this point, we're still seeing the consumer spend. Yeah.
And just to kind of put a little bow on that, Ben, I think regardless of the outcome of the Federal Reserve policies here, of whether that drives us into a recession at some point over the next few years or not, the point still remains, there needs to be clarity. So whether that, from an investment standpoint, for the stock market and the bond market to really start to feel like it's rebounding and heading back in the right direction, either investors need to feel confident that the Fed pulled off a successful policy here and that things are going to head back in the right direction, or they're going to drive us into a recession. And at some point, there's going to be light at the end of that tunnel, that the worst is behind us and that things are going to start to rebound. So it's just a matter of when, not if. And that's the biggest unknown right now, is just what is that experience going to look like until we reach that, bend in the river here to get to the other, the brighter side.
So when you were talking about holding cash, what are you trying to create a thing where you're trying to say, like, if we have cash, now's the time to start putting more into the market in the hope that it does rise?
I would take that conversation with you individually offline. Okay. Just because the answer for you may be very different for some other people. Right. It has to be with time period kind of first and foremost in line. Right. So if somebody with a really long time period that had excess cash, it might be a great opportunity to say, look, it doesn't matter if we go down 5% from here. If when we really want to see the use of this being out there, how many different years, then whether we go down another 5% doesn't matter. It's where do we see things in the next, couple years. Anybody, we had somebody that sold a home recently, and the question was, well, do I reinvest it in the market right way? I'm going to, want to buy another home probably next year. That's not a long enough time horizon to feel comfortable investing. So I give that as kind of the two extremes. It really does have to come down to your individual plan and when you're going to need money and time horizon. So we can certainly talk about that. Appreciate that engagement. Other questions, thoughts, emotional outbursts? Okay, then I'll kind of try to summarize it in just a few words. Again, everyone's investing experience is going to be unique to them, not only because of your own personal financial life, but again, investing is emotional. So we put this stuff out there to hopefully create some of that context, but we do not want that to replace an individualized conversation where certainly it's going to be a little bit more comfortable to ask questions or talk specifics, not in front of a group of people. So just because you were here today doesn't mean we shouldn't follow up if you want to do so. But if you don't, again, we hope this was good context.
Well said. Thank you, Ben.
Okay.
Okay.
All right. Has a wonderful rest of the day.
Yeah. Take care.
Thank you much, Lee.
Catch you soon.
All right. Thanks, everybody.